Welcome to the Dividend Talk Podcast, episode 174. The best of Charlie Munger's quotes. Dividend Talk is your number one podcast for all things dividend and stock market related with a unique European flavour. My name is Derek from Engineer My Freedom, and I'm joined with my co-host, European DGI. If you want to learn more about us, please visit EuropeanDGI.com, where we have articles on dividend growth investing, including 30 European dividend aristocrats. While you're there, you might as well grab our free dividend portfolio tracker template. We also offer a premium dividend growth service featuring a bi-weekly newsletter, which includes stock deep dives, dividend stock cards, and access to our dashboard with over 130 dividend growth stocks. All of this is based on our very own dividend safety analysis. But enough about that. Please grab a cup of coffee and let's get started. Hey, European DGI. How are you feeling today?
I feel quite okay. It was a bit of a busy week, of course. Also, like a roller coaster. I mean, we had Charlie Munger dying, the legend. So we'll get further on to that. But also, it's the time that Christmas parties are starting. So yesterday evening, I had a really good evening with some friends. A lot of vodka involved, herring involved. That's typically what you eat here. But I've been able to stay relatively sober compared to some others. But you know how it goes when you go out with some friends, only guys. So it's been good.
You can see I'm happy for a change. It's you. It's not me. It's not me. It's been you. Flying the flag for Diageo, but you don't look like someone that's been out. Usually when I'm dragged on a day after, I look a lot more disheveled. So I need to take a leaf out of your book, but
I knew I would have a podcast the day after, right? So you can't be totally wasted. Our listeners deserve the best from us. So
exactly. But hey, as you said, quite a week, and we'll get to Charlie Munger later on, because we're going to take some of his quotes and maybe talk about what they mean to us and what we like about them. But we do have two interesting pieces of news this week, both in the pharma world, mind you. And the first one is around AbbVie, ticker symbol ABBV. And they've been in the news because they are looking to acquire, or they are acquiring, ImmunoGen, which is probably best known, or relatively newly known, for their ovarian cancer drug, ELAHERE. What were your thoughts when you saw this news?
So first of all, I need to give compliments to AbbVie on how they have integrated the Seagen acquisition, how they've been fighting the Humira drug patent cliff, with the two, three other drugs that will completely replace the revenue and the income from that, and then over the next few years. They've been aggressively paying down debt as well. So for me, it is a story of very, very high quality management. It did come a little bit as a surprise to me, because I was expecting that they would still leverage down more, as a company. But on the other end, this is the thing about these pharma companies, right? These large ones, the blue chip ones, they live by the acquisition of high potential companies. Either it's an undervalued company with a strong pipeline, but you don't find them so often. So then you end up with those companies that are already a little bit further down the road with their development of drugs, and where that such a small company, for instance, can't manufacture and do everything themselves. That's why you can do licensing deals. But in some cases, it's also very, very interesting for a company like AbbVie, of course, to acquire the company. Now, when we look at the science behind it, I find it hard to judge. Generally speaking, 10 billion is a lot. What I understand is that I said this drug is very promising, and but when we think about immunology, therapy and such, and cancer, it's a crowded space, and some companies are really struggling at the moment with their pipelines. So I just hope that it won't be 10 billion down the drain, back to waste. On the other hand, they can, with the cash flows that the company is generating, they will be able to pay this down fairly quickly again here. But yeah, I like the ELAHERE acquisition much more because it was a mature portfolio. It's really nicely diversified. But I get this one as well because the science. If you can't do it yourself, you need to pay up for it, and that's the case here.
Yeah, yeah, it's a huge bet on this ELAHERE, which I don't think is one singular product from what I'm reading. It's a range of products, and it's been fast tracked by the FDA because apparently trials and so on have proved that it is probably one of the only drugs that is, I would say, proficient or actually kills the cells that it's meant to kill in ovarian cancer. So it looks promising. If you were to look into that company before take this year out of the equation, you would think they are absolutely crazy because the revenue, everything looks, the financials are quite poor, they're quite choppy. They were averaging around 65 million in revenue, and then the first 9 months of this year, then it's up around 212 112 million, all based on this drug. So that's what they're hedging their bets on. Like you, I don't know the science, the technology, or only what you read on that. But for them to pay 100% premium on the shares, that they're really betting big on this type of product.
Well, AbbVie has the scale. It has the best lawyers in town. We have seen how they've been maximizing their own pipeline, how they create this whole, how do you call this? This whole pattern. I said it's kind of like, and this is also where the industry is a bit dodgy, right? Because people complain about oil companies sometimes. But what a company typically can do is they ask for the first patent, and let's say, for instance, that this requires a hospital visit, quite some with the infusion or something like that. And then later on, they develop that it can be with a simple injection, and then they get a patent extension, and this is how they can really extend the patent. I don't know how how you call this, but this whole kind of sequence of patent extensions and also widening. So you start with one disease area, let's say ovarian cancer, and then you start to look for the others where it can also be beneficial. And that's how you suddenly can really get the maximum out of your revenue, also doing it in a strategic way. And AbbVie has been also often getting a bad reputation about, from this, right? From the way how they deal things, how they also with the biosimilars pay other companies not to release their drugs yet and such, right? To maximize this their profits. Of course, I'm a big AbbVie shareholder here. It's a large position in my portfolio, so I'm happy with this. But not everyone feels comfortable with that. But I'm sure that they use such strategies here as well. And then at a certain moment, 10 billion might be like if you zoom out 10 years from now, been a very cheap price.
Yeah. You only need one blockbuster drug to really propel you, and obviously with Humira coming up to its expectancy,
it's already
with that starting to drop off, they need the next big thing, and ELAHERE is a great acquisition, but it's not a blockbuster drug, so this is probably where they're looking at
the potential.
But we're going to talk a little bit about Pfizer, and they're discontinuing their twice daily weight loss pill. And I suppose this shows, even though you have got something in place, there's always risk that it might not be in place forever. So it's quite interesting, isn't it? I read maybe only 3 weeks ago they were betting big on this twice daily weight loss pill, and now they're pulling it due to adverse side effects. I mean, it's not a good look for them.
No. And this is also very interesting, right? And I think they will still release the data also to the industry so that others can learn from it, and I guess themselves as well. But look at what Novo Nordisk did. It's now the largest company in Europe, right? Novo Nordisk was a 60% contributing to GDP in Denmark. That's crazy.
Something like that.
That's crazy. Yeah. So I can imagine that any company wants to share the pie of this, and when companies have something in the pipeline there that looks promising, I mean, I can also really imagine that this props up the share price. And Pfizer is in a difficult situation. They had a really big windfall when you think about it from COVID. Yeah, they really were able to clean up the balance sheet because of that, and it was they won the lottery with that. Let's be fair.
Of
But if
course.
you now look at the share price of $29, it is at prices where it has been a very, very, very long time. Yeah. So everything that happened during COVID is just gone. Yeah. Gone from a share price point of view, if that's what drives you. So you get the company now at a 5.7% yield. Yeah. At that 5-year dividend growth rate of about 5% and a payout ratio of 56% right now. But this still assumes relatively high profits because the 2023 profits have been also a bit disappointing. And at the same time, they did a 43 billion acquisition of Seagen Inc. As well, right, earlier this year, which again propelled their debt from 30 billion to 61 billion. So this company is, I said, I just don't have a good feeling about this. Yeah, because I saw the documentary at the time with BioNTech that in the beginning, the CEO from BioNTech even said like Pfizer was not even interested in this COVID drug.
Yeah.
Yeah, and then in the end, they pivoted and they went with BioNTech and they won the lottery ticket here. And then I think like wow, management, what kind of management is this? Yeah, and then now we have this 30 billion acquisition where they are largely buying a pipeline. And you hear already in the narrative, when I speak about AbbVie, I give them the benefit of the doubt because they've been doing really well over the last, since the spin-off with Abbott. They have just shown excellent management, but Pfizer not. Yeah,
Yeah.
with Pfizer, there's always a lot of promises, but little delivery.
Yeah.
And that's really what I struggle with here. So, the company that they bought, Seagen, had also just 2 billion in revenues. I'm not even talking here about profits. Yeah, they're expected to make 10 billion in revenues or contribute by 2030, so in 7 years from now. And provided, that all these drugs in the pipeline actually are coming to life in the way as they estimated. So I have little how you say it, little faith in that management is having this right. Yeah.
Yeah.
So for me, Pfizer, on the other hand, when I think about this, and also, pulling back this drug, it's just very. I mean, I think the share price trades where it deserves because we had one of the listeners, Adrian, asking about this. When does it become attractive in your opinion? Well, there's always like I said, at a certain moment, if you can buy for $1 and they generate $1,000 of cash flow, then it's of course attractive. But generally speaking, for me, Pfizer, I've looked at it several times, and I just don't want it. Yeah, so whatever it trades at, I just don't trust management. Their pipeline is also not strong, and then they have this miss. Then they have acquired Seagen for quite a expensive price, where a lot of bets are in the future there. So I just don't find it a good company, a well-managed company. The yield is attractive. I understand that. I generally feel it as a yield trap. I didn't want it during COVID. I've been looking at it. I'm investing for 9 years, looking at it for 9 years, and every time I see something that I don't like in this company, and that continues to be the case. So I don't need it.
Yeah, I think Pfizer was one of those stocks pre-pandemic. It's fair to say it got a lot of hate. It moved nowhere.
Yeah,
probably 10 years or so. They got lucky with the pandemic, and I'm not surprised that we're seeing like revenues are going to drop. We all know that.
Yeah.
And I'm not surprised that we're seeing share price drop because of that.
Yeah.
But I am surprised at how management actually dealt with all that. I mean, they got lots of excess cash, and I know they returned some to us, well, not to us, but to investors, and they paid them some debt. But it just seems they could have done a whole lot more in terms of the pipeline. I look at the pipeline, and there's nothing there that excites me. You see something for Lyme's disease, for lymph cancer, and all, but I don't see where the blockbusters come from. I'm not a scientist, so there could be something, but there's nothing there. Even that they are saying that's giving me hope that they have the next blockbuster drug, and like even reading what this company was it Seagen or I'm struggling to struggling to find something
Yeah.
really tangible and something to be excited about. So
So almost all the money that they earned, let's say from COVID and such,
it's
have
gone into this.
gone in this company in the single bet.
Yeah,
Yeah. Now they won once the lottery ticket. I don't see them winning it twice really quickly. So yeah, I mean, really simple, Adrian. I'm staying away from it. I don't like it. Maybe in 10 years from now, if management has changed, they get the science together, the acquisitions play out, then I really don't mind being late either and buy it for double the price if the cash flow is good and the dividend continue growing. For now, I just have the joy of missing out here on this one. It's really simple.
yeah. I think there's better or probably, yeah, there's probably better options out there. Even European company, Eli Lilly is probably one that you could look at. It looked like it was going nowhere, but they've seen steady growth over the last 5 or 6 years. It just seems better managed. I'm not suggesting you went and buy that over Pfizer, but I just think that Pfizer's been in the news. COVID helped it. It has a high dividend yield, but that could be a trap. So I would stay well clear from it. Good. Some dividend hikes of note over the last couple of weeks. Canada has really came forward. You were on a podcast. I can't remember if it was this year or last year with the dividend guy, and I know you had a long conversation about ATD, which is alimentation couche tard, and he'll be quite happy. Mike will be quite happy to know that they have a 25% dividend hike.
Insane. Wow.
25%.
Yeah. I mean, we know this company here in Poland from Circle K, the gas
Yeah.
stations. Yeah.
Yeah.
That's the owner. And for me, I mean, it's like Ahold Delhaize, right? This company. And yeah, I mean, I think it's a unicorn in Canada. Let's call it like that. Yeah. Not those growth stocks, but as a dividend grower, amazing company. And doing a 25% dividend hike is superb. Really.
Yeah.
Can't say anything else.
We know Mike was really beaten there. I suppose ever since I've spoke to him on day one, he was on our show. He's always spoke about this company. If you type in the ticker into Twitter, it's nearly all him talking about this company all the time. So he seems to have picked a really good one. But 25% is kudos to them. And sticking with Canada, we've also got some of the banks raising their dividends. Just some notable ones. TD Bank is increased it by 6.3%. And we also have the National Bank of Canada, which raised it 3.9%.
Yeah, you know my thoughts about bankers, right? But the Canadians ones seem to be special ones.
Yeah. To be fair, every Canadian we've had on the show has spoke quite highly of the banks, and they just keep churning out these increases. And
they
so
seem
on.
to be right. Yeah, they seem to be right. For me, it's just too hard to, to understand it, therefore, because they're most of the times also very local. So when you're in a local bank, I think you also need to understand the culture, why people use those bank products, what is the regulation there, is the regulation indeed conservative and focused on the investor?
Yeah.
It's a bit too hard for me.
Yeah. Okay, we'll move on to our main topic, which is all about that man, Charlie Munger. I think we were all shocked to hear the news on Monday, but to be fair, 99 years of age, he's lived a long and pretty decent life, I would say.
Oh man, and you know, I own also Charlie's almanac, right? And I gave you one as a present also earlier this year.
Right,
and I've been reading it. I guess I'm halfway or something beyond that. And this guy is just a legend. I learned so much from the man. 99 years old, and I wish I could get as old as him. I think really the fact that Charlie and Warren are still so active in reading and everything, I can truly imagine that this also helped them getting to an old age. Of course, having the money for their yearly checkups as well. God knows whether they had cancer along the way, but I'm sure they have the best doctors as well. They could pay any cure if they need it. So they have certain privilege, which they also worked hard for, I would argue. But if you have the money and you have the brains and you keep playing Sudoku, let's say, but then using annual reports and financial statements, I can truly imagine that this is the secret to a long life. And I just wish that I could also live so long and just doing
Yeah,
what I love, because the
yeah,
guy was so passionate, right? And very witty at the same time.
yeah. He had a purpose, didn't he? And that purpose just kept him going and going. Obviously to an old age, and you see that. Well, I don't know if you see it, but typically you see when people retire, quite quickly they start to decline because their purpose is gone. They've been working so hard for so long, and that changes. Where it seems like Charlie and Warren as well, they seem to have a purpose, and that just keeps him,
Yeah.
keeps the brain working, keeps him young, keeps him active. But yeah, it's some he's had some truly inspirational quotes, I would say. But what has been your favorite? We maybe talk maybe 5 or 6 of them, but
Yeah.
what's been your favorite one?
The favorite of all is that the big money is not in buying and selling, but in the waiting. And I think this aligns so much with my learnings also from dividend investing. I mean, every time when I was touching stocks, I no, not regret it. Sometimes actually not, right. I still sold Tupperware on time. But for instance, let's say it differently. We've been buying stocks like now this year, like the insurance stocks like ASR, Nationale Nederlanden and such. And then ASR now, right, is doing pretty well again over the last few weeks. But you just know that you're buying these stocks when many people are hating them because of the interest rate environment. However, if you do the analysis on these companies, they're so cash flow rich, having a strong dividend policy. So there's a lot to like about these companies, right? But then for me, it is really in the waiting. Yeah, just put them on the shelf, wait 10 years. If they continue to have this kind of same approach to the business and they show growth over those years, why bother? Stocks can be longer undervalued or undervalued for a long time. And for instance, think about the British American Tobacco of this world as well, right? That they don't get the same multiples at the moment because of ESG focused investors and pension funds and such. But in the end, the cash flow is there. It allows the company to buy massively back shares. The same as with Shell. So you just need to wait with these kinds of companies. And I have had so much over the last 9 years that what I always call these pops. Yes, suddenly a company is just trading and suddenly pop some news and they go like 10-15% up, and they never come back because they made this thing that you always were expecting or anticipating already in your own homework. At the same with ELAHERE at the time. I bought those shares at the time for 16 or 17 euros because Amazon was entering the retail chain market with their acquisition. Was it Whole Foods, I believe?
Yeah.
So if you do your homework, it's not about buying and selling, just waiting. And also, like, if you buy and sell, I would really like buy high and sell low, and then all the commissions on top of it. But let the compounding do its work. That's really what this is about, yeah. And the compounding is a special one here.
Yeah, exactly. Yeah, and if a company has good fundamentals, there's definitely no need to panic, and that's where the waiting comes in, because you already own a company. Sometimes it's so easy when there's a lot of negativity in the news. Let's talk about real estate, for example, at the moment. We know interest rates are affecting them. It's so easy to exit them because there might be better options elsewhere. But some of these companies, we look at realty income, the fundamentals hasn't changed from what it was 2 or 3 years ago. They were a good buy then at $50, $60. Now they're trading at 45. There's no need to panic and sell them. So I think to be a dividend growth investor, this is definitely one of the ones you need to learn the quickest and the most, I would say.
Yeah, and I started with buying and selling before I found dividend investing. I was doing it with a few €100, but that's where I was, and I got nervous when it was 2% down. Yeah, really simple.
Even as a dividend investor, I've done it. I mean, I felt like a company was overvalued. ADP was one of them. I bought them. They went up 40%. These guys are overvalued, but honestly, they haven't even touched where I sold them at. They've nearly doubled in price. So it's definitely a lesson. I think everybody will learn it at some point. You're going to sell something. You're going to panic at a certain period, but honestly, just sit and wait. It's probably the best thing. Wasn't there an interesting stat that like the best retirement accounts were from people that were already dead?
Yeah, exactly.
They never looked or touched them, and it just kept compounding and growing and growing. It's It's quite
Yeah.
funny, but
So actually, we should do well when we die and just tell our wife, tell nothing to our wives about our portfolio.
yes, just say it to your kids. Just say it to kids. Yeah, just look at this in about 30 years' time.
Yeah, exactly. Yeah, have such an email coming in 30 years from now. You can schedule it forward and say like, "Hey guys, now finally have a look. There are some dividends waiting for you."
And pray Gmail is their thing in 30 years' time.
Well, that's another topic. How would you ensure that your message would be arriving in 30 years from now? Yeah, that's not
Yeah,
so easy with the technology, right? Because
no
30 years ago we had maybe just DVDs,
pigeons.
pigeons. Yeah. How old can a pigeon get?
Exactly. Yeah. Yeah.
So you need to then depend on the pigeons telling the stories to their grandchildren.
Yeah, and then sending it on, and there'll be like bits missing and
Yeah,
so on. But yeah,
exactly.
it's that's definitely a topic for another day. But I have to say, one of the most inspiring quotes I think from me was, "Spend each day trying to be a little wiser than you were when you woke up." I love this, and it's something I try and teach my kids all the time. Like if you get better, just even 1% on even 0.1% a day, just every day,
Yeah.
where you'll be at the end of the year or the end of their adolescence is quite significant, and it's something that really resonates with me because not every day I would say, but I do and try and instill this as much as possible, and that involves what Charlie loves doing, which is reading.
Yeah.
You have to read, you have to talk to people and learn from their experiences and really take that going forward. But I think this is such a powerful quote for me.
Yeah, and the fact that he died, right? How much knowledge passed away with this as well? Because when you go through Charlie's almanac, he has been reading all about the great philosophers over time, right? And he has been reading of, he wasn't just reading like finance. He was reading philosophy, things about nature, and that's so nice about it, right? He started to recognize patterns that he also sees in the stock market, and I think you can't describe these patterns even. I think it's the feeling that you create for it by how is it, reading so much about this. So yeah, I mean, it's not something that I think about. I need to be wiser today a little bit more than I woke up. Usually I need a coffee first, and by the time I have my coffee, I'm already in my email at work. So but I get it. I think this is really applying to the growth mindset, right? Where you continuously want to improve yourself, and curiosity is key here, I think, as well. Yeah. So another one that I really like, and that's more like I said, a little bit probably with my type as a person as well, and that is this like invert, always invert. Turn a situation upside down, look at it backward. What could go wrong? I find this so interesting because often when I'm analyzing a stock or looking into things, I try to do this back on the napkin calculations. Yeah. And for me, this really helps me in figuring out like, okay, you know what? But what, for instance, let's say like with the Seagen acquisition of this 30 billion of Pfizer, what if they don't get this 10 billion, but just 1 billion? How does it look like? I do it in the valuations when I do it right with the discounted cash flow. It has been maybe doing 6% or 7% cash flow growth over the last 5 years, but I always make sure that I have a controversial case in there. And then still it goes wrong, right? The one thing where I'm always what I find hard to assess is potential litigation. Think about 3M, Bayer, and the consequences of that. So think about other stocks you have in your portfolio now, and yeah, what if they would get a certain litigation against them? Like, let's say Novo Nordisk. What if Novo Nordisk now seems to, in the long run, kill people with their weight loss drugs or cause depression, or something like that? Like, it's hard to do it, but at least what this triggers is always to consider all the possibilities of where it could go wrong, because if you have assessed that and you still feel comfortable owning the stock, and then I did this with NN Group. With NN Group, I really did an assessment of what if with the court ruling they had to pay all of this, and how much would it probably look like if they settled. I looked at the data, historical data and such, and based on that, I'm not nervous around NN Group. Yeah. So, and this is really what this always invert quote from Charlie Munger really does to me, to make sure that we're not blindly falling in love in a stock, and really look at at the long term, at the potential business impact and the risk as well.
Yeah, I can agree. I think we know each other nearly 5 years now, and if I was to pick one quote I'd associate with you, it would be 100% this one. And not just in stocks and everything. We have all sorts of conversations about goals and risks and stuff, and you always challenge me on that one as well. But I think it's something that's harder to learn. It's probably more instinctful in people. Sometimes it's more natural. It's probably more natural for you to do that than it is for me.
I'm naturally a bit more risk averse. Yeah. It's really simple. I'm not the one that goes to the casino and such. It doesn't even work on me. I find a loss of money. Well, I know that you would like an evening in the casino.
Yeah, exactly. So we're quite opposite there.
Yeah, you own Vici. I don't. Because I don't understand why a person would even go to a casino.
Yeah, but you also own Evolution, which is gambling.
Yeah, but they earn from those people. Yeah, okay, you could say from Vici as well, but yeah, okay, good point. Is that corrected? Forget the last 3 minutes of what I was all saying.
Move on to our fourth one, and do you know what? This one always reminds me of my wife because she does it a lot better than I do, but it's something I try to do, especially professionally. I think in work, I take a lot of the younger guys and girls under my wing and try and help them. But I think the best thing a human being can do is to help another human being know more. I think that's really, really important. I mean, I don't know in your line of work, but I know it can be really cliquey in my line of work where people don't like to share knowledge because it's all in technology. And if I know more, I'm more employable, or I hold all the cards, but that's just not how I operate. And I think that's part of the reason we started this podcast as well. We wanted to give a European perspective, and we do target beginners a lot more for that reason, and to try and pass on a bit of knowledge. And if we can help just one or two people even start investing, then we're quite happy. So I think that's a really, really strong one. Really resonates with me as well.
Well, speaking of which, we have 174 episodes now. And I believe we almost doubled the audience this year, like 84% or something like that. 2,500 minutes we've produced. It's insane when you think about it. And then we have people that listen to each and every minute on this podcast.
Yeah. It was. I was blown away by the amount that was in our top 10, but our top 1 podcast was like, I don't know, crazy amount. I can't get over that. Actually, before that came out, I didn't know Spotify was doing its whole, and this is just Spotify, mind you, it's not the other platforms. But before that came out, a couple of guys in work had sent me screenshots of that, and we were in the top 5 in each of the 4 of them. And I kept saying, why are we not number 1? Why am I 4 or 3? But it's still mind blowing that people I work with, I'm top 5 podcasts they listen to, and there's some really cool podcasts there too.
But you know what is also about this quote, right? Then what I really love is about sharing knowledge is that you see a smile on people's faces. Yeah, they appreciate it and such, and for me that's the nicest you can get. Yeah, and I don't need an articulated appreciation, but just seeing that someone made a step forward in their life with whatever it is because you shared some knowledge, or without asking, you offered to help someone with something, spend a few hours to help them in their house or something like that. I mean, why else do you live? Yeah, I don't live to just sit on my own.
It's interaction with other people and people with common interests, and if you spark something in someone, who knows, it could flip and they could teach you something in a certain time. So yeah, I think it's a really good one, but it also leads to another quote that I like that he said, which is, I try to get rid of people who always confidently answer questions about which they don't have any real knowledge. And I think that is, and I see that, I think of Twitter. We see all these accounts. Some people are not as transparent. They hide there's one. I'm not going to pick on accounts, but there's definitely one out there that has changed its name 2 or 3 times, and it went from an expert in 401ks to housing to dividends.
You mean the dividend kid that is now the finance guy?
I didn't say names, but yes, that's what I was talking about. But you get what I'm saying. There's always these type of people who will give you advice and tips
Yeah.
and on something they haven't done. And I can
Yeah.
hand on heart honestly say everything I talk about, I do myself.
Yeah.
I'll never say try this unless I have
Mhm.
100% tried it
Yeah.
myself.
Yeah, this is a tricky one, right? Because I struggle with this sometimes. I don't try to even answer often questions that I don't know anything about. And we have said so often when we get questions from the listeners, like, look, not my circle of competence or something like that. But I also know that I build confidence based on when I study things. Yeah, so that's a tricky, right? I can get opinionated about things, yeah, about banks or whatever it is.
Yeah.
So it is not an easy one, but
Yeah. But the distinction there is, right, this says in which they don't have any real knowledge. If you take the time to study something and form an
Mhm.
opinion, you have some knowledge in that based on your experience and
Okay, yeah.
what you believe. You're not going in there with very limited knowledge or very limited research
Mm,
or anything. You've already formed that. So
yeah,
I have no issue with that. But for me, it's if you just hear something once and you
yeah.
take that as gospel and then you're preaching that everyone else,
Yeah,
you have no knowledge in
yeah,
that. You're just rehashing what is
yeah.
already there.
Luckily, I don't know really any of such people. Sometimes I see people that are influenced by propaganda from based on politics or something like that, and I find
Yeah,
it hard to discuss because they always have a fact that that is for them. Then they say the world is purple, not blue. Yeah, or the air is purple, not blue. You look outside, it was blue, and they say no, it's purple. Yeah, then you can't even have a conversation.
yeah.
But maybe I'm wrong. Yeah, maybe they are right. Who knows? But this is often how it goes in politics, right? And then you end up sitting there, and
Yeah.
then I usually just say nothing. I mean,
I can't believe you don't know too many of these people. I mean, I work in a
but
place.
some you get via your bloodline. It's not like you have a choice. Yeah.
Yeah, but even professionally, I must know at least three people that I can confidently say fit into this category.
Yeah, I
Yeah,
don't really. I don't. No, no, not no, not that. No, not really a lot. Maybe I just ignore them.
yeah, yeah,
Yeah. Yeah, then maybe when one that I also like is like the best way to get good ideas, to have lots of ideas, and the way to have lots of ideas is to read. And then we spoke about it already a bit earlier how much she has been reading. And for instance, I have the same. I have this stupid thing that I cannot just sit and do nothing. Yeah, even a movie or something like that. I get so many thoughts in my head. So when I'm reading, I really get peaceful. But also, what I noticed over time that when I'm done in other situations and we are trying to solve problems, I usually can refer to something I've learned in the past via reading. So some people would then argue like, "Oh, you're creative, but you're not really creative as such in the sense of that you're inventing new ideas." Yeah, like you smoked, a few grams of marijuana and suddenly everything comes to you. But it's more like I'm just well read. Yeah, and then you see like across industries or something like that. Oh, they've done that there. Maybe we can apply it here. So it's more like cross pollination that you get, right? So it's not so much as being creative, just knowing how applying the knowledge you have, and this has been helping me a lot through my life in my career as well. And I believe if you read a lot, so if you get home and you spend the whole day watching Netflix, and if this is Netflix is like pulp and not documentaries or something like that, I think people that are at your same age, same educational background, that are using the time to read non-fiction books or watch documentaries or go out and talk to people that are working on other stuff and having conversation about that, I think you have already an edge in your career and it will pay off. So when we are talking about financial independence, it's one of the most important things is your savings rate. Costs you can only save so much on. So if you want to increase your savings rate, it's your income. I believe this is really a path to
yeah,
wealth. Read a lot, and you will outshine some of your peers at work. It will quite quickly become visible, and you'll be very useful and handy, perceived by many people.
yeah. And I honestly believe that edge will get bigger and bigger as the generations go. I mean, you just have to look at the generations coming up behind us, and
Yeah,
they are already binging on shows. They're already looking at snippets on Twitter, or not Twitter, TikTok and Instagram Reels and all this, and everything is so fast paced. I don't know too many children now that read. I don't know
Yeah.
too many children that take the time to sit there in solace and even formulate an opinion, because everything has been
Yeah.
fed at them from something else.
Yeah,
So
so our children, they are not allowed to do that. It's forbidden for them to be on YouTube and such, on shorts and everything. They need to read if they want to play computer or
yeah,
something like that. We forbid it because, you know, even YouTube shorts are so addicting. I notice it myself. Once you click it, you're like straight away half an hour further.
yeah,
Yeah, it's insane, this. And I think we will see this. We will see this happening to society at a certain moment, and yeah, it will be a big issue, I think, in some areas.
yeah. But maybe just do a couple more. One of the ones that I do really like. It's not the strongest of the species that survive, nor the most intelligent, but the ones that are most responsive to change. I think that's really important, because I don't know about you, but growing up, I always felt like I had to be a perfectionist. I had to be the most
Yeah,
intelligent in the room, or I had to know more than the next person. And I used to always challenge myself against other people, in order to try better myself. But in actual fact, it's probably a waste of time, because situations, I mean, look, I'm here on this nearly, what, 4 decades now, nearly. How many changes have we gone through in
mm,
those times? It's incredible. Like, so, uh, I think how you change and how you react to change, and specifically as investors, I think this
yeah.
is really important.
It reminds me, this, like, how I said, streetwise versus textbook smart, right? But it also reminds me the Darwin Awards. Have you ever looked into those, the Darwin
No,
Awards?
no, no.
Ah, it's a website. You should look it up. It's so interesting. So every year you can submit cases that happened in the world, and then they will announce the Darwin Award. And there's also, I think, a movie about it. So, for instance, there's a guy that is very proud on his career, and they make the strongest glass, and lives in Manhattan, wants to show off to his friends, and then they say, look, you know, if I throw a pillow against it, it won't break, and such, and it can catch me. And then it takes a pillow, jumps against the window, and jumps through it, and falls off the building. Yeah, fully convinced that the science behind it, about behind the window and everything, would be so strong that it can deal with all these kilos. But then, yeah, I guess a miscalculation, they died. So the Darwin Awards is all about, like, either dying or becoming impotent, like not being able to make kids anymore.
Yeah, yeah. So I was just looking at it as you were talking. I was like, what?
Yeah,
I just,
yeah, exactly. Or you know, okay, this one, that was maybe not the most smartest guy, I would say, but maybe uh, an interesting one, that how I said, they put, I kind of like the girlfriend, I believe, was jealous one time at the gas station that they saw Ferrari standing there, and she was kind of like, you know, flirting with the other guy, yeah, with the rich guy, like, let's say. And this other guy had a pickup truck. So what he did is he went to such a store, bought an old rocket engine, stitched it onto the pickup truck, went for a drive with the girlfriend, said, "Look at this," turned it on, and crashed against a mountain wall or something like that, and died. I mean, this is what the Darwin Awards are about. But actually, some of these winners of the Darwin Awards are very, very smart people from intelligence point of view, but they
yeah.
made the most stupid mistakes.
Oh man, yeah. I was just reading a couple of them. Yeah, yeah. Just look it up. It's mind blowing. Some guy actually went into a car wash on the outside of the car. Why? Why would you do that? I don't get it. So yeah, yeah. Maybe they didn't respond to change quite so well.
No, not so, not so. Hey, look, another one that I find really interesting. It's like it's remarkable how much can be learned about the world by reading about how people have screwed up, and this is also right. I mean, we should be empathizing with people that do stupid things or screw up, but at the same time, it's so insightful, and then I'm happy sometimes in life, like, oh, this could have been me. Yeah, but it wasn't. So at least I learned now that I shouldn't do it. Yeah.
Yeah.
So I have that also sometimes. So there's also a really nice one of those quotes. And for instance, investing everything in a certain crypto on FTX, and then your money being locked up or something like that. I mean, it could happen to others as well, right? Not to us really, because we don't invest in crypto. But if you invest in these new exchanges, yeah, this stuff can happen. So sometimes you just learn from others. But maybe the most iconic last one that I really want to call out from Charlie Munger is this one. I think you would understand any presentation using the word EBITDA if every time you saw that word, you just substituted the phrase bullshit earnings. And this is what it is. I mean, EBITDA. And then some companies have even adjusted EBITDA.
Adjusted EBITDA, yes. Who do we have? We had someone on the show last year, and they're a fan of EBITDA, YouTuber. I can't remember the name.
Cameron Stewart.
Cameron, that's it.
Yeah, because that's how the financial industry evaluates companies, because it's the most stable kind of earnings, as they call it. But for that, you just have free cash flow. Yeah, you can adjust everything. You can look at everything there, and it's harder to be manipulated. But free cash flow usually looks a little bit more poor than EBITDA. So and if you tie your bonuses to that, then I can imagine why CEOs want EBITDA. They can make it as nice as it looks like, and then the adjusted EBITDA for the special one-offs. So I fully align with that, and I think we have never really used EBITDA in anything we do here.
No. We certainly have not. So look, that was our little homage to Charlie Munger. Could obviously speak a lot more. There's so many quotes. I mean, you spoke about his book. I mean, there's nearly 1,000 pages in that, I think, and it's just all like you sit there and you can pick it up at any point. You don't have to read it in order. It's a fantastic book, and I recommend it to anyone.
And what I would recommend also is, like, if you're European, right, you would maybe look up on Amazon on Charlie's Almanac, and you will see that you have to pay more than €100 for this. Guys, if you're really interested in having this book, they cost like $50, at least last year when I bought them. But you need to go to this institute or this library from Charlie Munger. It's a website somewhere online. They will ship it. It will take 3-4 weeks before it's shipped to you. Probably costs $40 for shipping as well, but you get it brand new in the package. It's still cheaper than when you buy it on the European Amazon somewhere. And if you do it with a few friends together, you can even share the shipping costs. It's an almanac, lots of pictures, lots of stories from family members, from good old friends of Charlie. So if you're like a long-term investor and you love Charlie and Warren, it's for me like a must-have collector's item, this book. So highly recommend it.
Yeah, 100% agree. We'll move on to some listeners' questions. And the first one is from Simon. And he's asked, is there any dividend-related topics where we actually totally disagree on?
Well, over time, I think we have grown towards each other, right? Because in the beginning, we were much more different here. But let's say I don't really buy these CEFs, as you call them, although UK wind kind of also changed my mind, let's say, this green coat. But I think there are some things that you typically buy that I would really stay away from, and I would consider them sometimes yield traps, like you had with Walgreens as an example. There were a few more of those stocks, because if you put our portfolios together, they look totally different. That's the interesting thing, right? So our stock picks, I would say, we often disagree in such sense.
Yeah, fundamentally the same principles are there, but how we apply them.
Exactly.
Can be different. And closed-end funds are definitely an area that I have more of. They're better than ETFs in Ireland, for reasons I've stated before, which is why I have them. But again, we spoke about gambling stocks and some of the sin stocks that I have that you don't have as well. So some of the companies that we have do differ, but as you said, dividend growth investing, it's hard to disagree on a lot, unless you're buying AT&T to the moon. You're going to agree on quite a lot of stuff. he also asked, Charlie Munger turns 100 on the first. When was this question? This was from a previous one, was it?
No. This was asked during the week.
Oh, was it? Okay. So he said Charlie Munger turns 100 on the 1st of January, and Warren is only 7 years away from his milestone. While it is not yet a dividend paying company, what do you think will happen Berkshire Hathaway's share price when nature takes its course?
Yeah, and Simon also in the comment behind it the day after put the link like, oh God, I hope this was not my
Yeah,
the
yeah,
reason that I posted this. So
yeah,
look, I think when Warren Buffett dies, it will really tank a little bit. That's what I think, but not as much, because although we don't know the people behind them yet so well, because they are typically not too much in the public. I think this company is set up. This company just can't stop spitting out money. It's been built over 50 years. It will at least take 10 years to damage it. Yeah,
yeah,
by incompetence. And that's how this company is structured, how it's set up. But of course, when both of them are gone, I can imagine that maybe some people smell wealth, yeah, and maybe want to get a bigger share of it. If it ever will pay dividends, I don't know. I think they like buybacks more. They feel that they can also allocate money better with this money, because why would you pay dividends to shareholders only when you think as a company that you can't get a better return for this money? Yeah,
yeah,
then and that you want to give it to the shareholders so that they can get a better return elsewhere with that money. So yeah, I don't know. I think like any stock, there will always be opportunities to buy at once.
yeah.
I just hope that Warren Buffett gets to 100. I wish this for him.
We on the subject of quotes, one that stuck in my mind as you were saying that is Peter Lynch's one. Go as a buy a business that any idiot can run.
Yeah,
And look, I'm sure we know how intelligent both Charlie and
yeah,
Warren is. I'm pretty sure, not to say that the guys running him are
yeah,
idiots, but I'm pretty sure that they have systems and stuff in place to help that, as you said, last at least 10 years down the line. So
yeah.
whether they'll pay a dividend, I can't see it.
Mhm.
I think the guys that are running it now are probably they've been learning quite a bit from their two mentors, and I don't see any reason for that to change just because
Yeah,
they move on to a better place.
yeah, definitely.
Andrew has asked us about our thoughts in initiating starting positions with companies when their share price is slightly down, with a view to purchasing more at a later point when they offer better value.
Oh, I do this often, actually. Maybe I mean often. I don't do it a lot. Don't get me wrong, because I don't initiate new positions so much. But yes, if I feel like I really want this company in my portfolio, let's take ASML as an example. I buy one share, and then just to get to understand the company as well. So because at least then you start following the news, it gets on your radar. You see it every time when you open your portfolio. It reminds you, but then you're also more aware of when the real opportunity arises. So yes, I do this relatively often. Usually it should be around fair value price or some. I did with L'Oreal the other time. I did the first newsletter that we did for Dividend Growth Pass. Compass was about L'Oreal, and I bought some L'Oreal at the time, knowing that it was not heavily overpriced, but at the same time also thinking, yeah, this is an initiating position. It's in my portfolio now. It will be all the time in front of my face. So when the opportunity arises, I can pull the trigger much more. So yeah, Andy, I'm doing this. Actually, most of the times, I would say.
Yeah. Okay. Yeah, I kind of guess that you do that quite a bit. I don't really see the issue with it either. I mean, they might not go down to that price. That's the thing. So you have to be prepared for that as well.
Yeah,
They might go the other way, as you said. They might have that pop you were
yeah,
speaking about. So that's just a scenario we have to be ready for. But yeah, if you have a fair value at a price and then you'd like them under that price, there's no harm in waiting. Dividend Growth Quest has asked us, how often or how much do we take fees into consideration?
So not anymore so much. Although it's very important because fees can really eat up your profits. So let me tell you which fees I hate and I don't want in my portfolio. Those are maintenance fees. That's why I moved all my money out of Saxo Bank and switched it at the time to Interactive Brokers, because those fees, maintenance fees, they are like I said, they are like a kind of a subscription cost, and they are tied to the value of your portfolio. So if you have a portfolio yield of 3.5% and the company charges 0.3% in such a maintenance fee, then you in the end get only 3.2% in income, which I think is something I really hate. When it comes to commissions and on the transaction, I'm a little bit less picky. I typically buy, let's say, in slots of €1,000. So anything below $10 is still fine for me because I aim to never sell again. But I'm, of course, at low-cost brokers. So I think at the Giro I pay typically around €5, including FX fee. And at Interactive Brokers is probably, what is it, €3-4, I would say. And that's fine enough for me. But if you were he says, like, if you buy €200 worth at the time, yeah, it becomes much more, of course, right? So then I would have, let's say, in this case, he says €2, keeping it under 1%. Yeah, it is already a lot, but at least if you aim to never sell, then it's a one-off, and you should do well. If over time you are able to increase the monthly investment to €500 or something like that, while the commissions stay the same, then I think you're well off. Because if you could also say, like, okay, why don't you save up this €200 until you have €500? But then you get this issue with dollar cost averaging. If you can only invest €200 per month, I would rather pay the €2 commission than €2 commission on 500 and then only buy once in 10 weeks. So I would always recommend that in such a case the dollar cost averaging, because otherwise you go more towards timing the market.
Yeah. I mean, it is more so smaller the account or the smaller that you're purchasing, fees can really eat up into that. So I feel like, especially when I was starting, I was buying 5 or 6 companies at a time, but I realized actually I'm only investing a small amount of money and I'm paying 1, 2, 3, 4% each one. It does eat it up. So yeah, I'm with you. I have both the Hero and Interactive Brokers. There's not much in the difference between them. So I don't take it into consideration, but definitely as a new investor, or if you're only investing, I mean, I'm going to say relatively small because it could be big to somebody else, but it can play a huge factor. And then you've also got likes of trading 212, which don't have fees. You're paying the spread, but it can help in the beginning to minimize those fees if that's what you're looking for. MH79 has asked us, do we know anything about the ETF Wisdom Tree Global Quality Dividend Growth UCITS? He said they seem to be focused on quality and not on yield. What do you think?
I think it's a relatively okay one. Yeah. So, like he says, it's high quality dividend stocks. But if you think about this, I would rather probably go for the, although it's, let's say, a lower yield, it only pays like 2.16% right now, but I would go for ticker symbol FUSD, which is the Fidelity US Quality Income UCITS. Because it is also a nice dividend growth. But I think this one from Wisdom Tree is let's say equally in its performance. But you just need to know that even FUSD, for instance, as an example, the dividend income in 2022 was lower than in 2021, because in 2021 there were a lot of special dividends, right, in this year. Of this COVID boom where the profits were surging and such with some companies. So I think you always need to look into account. So what I would always say is, like, also with this one, just look at the dividend payments over the last 5-6 years, see if they are in an increasing trend or not. And based on that, make your judgment call, because you will be surprised sometimes that they go up and down or just flat over 5-6 years, while they even might have dividend growth in the title.
Paul has asked us, he said, Fred, Waller, and Daly are more dovish than expected. Is this really good for stocks? Lower rates when we expect lower to negative growth. What are our negative plays?
So now we're talking here a bit about macroeconomics as well. I find it hard to say it. On the short term, lower rates are bullish, generally because the cost of capital becomes lower, which increases the valuations of companies. In the long run, I would like that there's better and more fair competition, that the zombie companies with all these debts just get washed out and due to high yield environments, because this is difficult for companies with bad balance sheets. They will get punished more, and it will let the good companies thrive more. Yeah, so I'm actually okay with a bit lower, higher for longer when it comes to the interest rates. Let's say it like that. But Paul, I'm not thinking like that when I think about my portfolio. I don't think about playing the market like based on interest rates. I just made use of the opportunity of the real estate investment trust and the insurance companies this year that got punished by the interest rates. But I'm not really thinking at it like that as a strategy.
It probably would have been a good question for Leo, who we had on last week, who we know uses macroeconomics in making his decisions. We're probably not the right guys for that because we don't, and we said we don't. In theory, we know what the theory books say. Yes,
Yeah.
That they're more dovish probably is better for stocks, but I mean, it doesn't necessarily. The market can be irrational at times. It doesn't necessarily mean it's going to be bang straight away. Stocks now they have gone up the last 2 or 3 days. So, but look, who knows? Who knows?
Yeah.
Julian has asked us a really good question. Considering some of the best companies in his portfolio, he's thinking of the likes of Nike, Starbucks, AbbVie, are all raising their dividends much less than what they used to a couple of years ago. He's wondering if the dividend growth investing strategy really exists. What do you think? Does DGI have an expiration date?
Yeah. So look, in world's history, and we go 400 years back when the first stock market existed, every company goes one time bankrupt or it gets acquired. So technically, yes, but it may outlive us. Yeah, our portfolios, the companies in our portfolio will probably outlive us. Yeah, by the time we die. The question here is like, why are they lowering their dividend hikes? And yes, it is true that this is happening from Nike, Starbucks, AbbVie, and Texas Instruments. But how many double-digit hikes have we seen also over the last few months, right? And just today we spoke about the Canadian company Couche-Tard, and generally what I see with these companies, if we look at all of these, AbbVie was benefiting from a low interest environment while paying off debt. Yeah, so they could hike the dividend a bit higher as well. But now in a higher interest rate environment, more of the income will be used for debt servicing. Texas Instruments is just going through a 3-4 year capex cycle, heavily investing in the future. So they can't aggressively, hike the dividends at the moment. And Nike and Starbucks are probably foreseeing an earnings recession, because of a weaker consumers. Because everywhere where you look, you see that the consumers are under pressure. So they are probably slowing a bit down their dividend hikes to make sure that if earnings are growing slower, that they don't increase the payout ratio too far. So, but this is where the market comes in swings, right? Sometimes there's an earnings recession. The other time there's like very bullish. And typically the blue chip companies, you see them a bit hiking dividends in line with that. Yeah, and specifically there. So I think for all these four, like Nike, Starbucks, potential earnings recession, AbbVie debt servicing, Texas Instruments, heavily investing in the future. In the end, they all have their own story that you need to understand, and therefore also answer like, is this now the end for the company or not? And I think with these four, for none of them, it's the end. They are just managing their payout ratio given the business circumstances.
Yeah. What goes up must come down. Eventually, a company, as you said, will go bust, get acquired, they stop paying a dividend. But the
And we have examples: AT&T,
Yeah.
VF Corporation, two companies that had really good history, and the dividend history has gone down the drain. Yeah.
3M might join that eventually if they keep going. You know,
Yeah.
it's you don't know what will happen in the future. And as you said,
Yeah.
it's markets are cyclical, companies are cyclical.
Yeah.
There's up and down, and you just have to ride the wave sometimes.
So let me do a plug here, because our Growth Compass newsletter that is available via EuropeanDGI.com. Julian, of course, we are really looking there at the dividend safety, right? We try to really assess the dividend safety of a company, and yeah, I think that's what's the key here. As soon as you see that the dividend is not safe anymore, I think it's a time to sell the company. Take your loss at that time, or take your profit, whatever it is. But yeah, do the portfolio management.
Tim has asked us about free cash flow to yield. He said some high quality companies have a really high PE ratio, which puts people off, but they might have a decent free cash flow yield. Do you ever consider this in your valuation?
So over the long run, those should be relatively in sync. Yeah. But it can be that a company is underinvesting, but still having the depreciation from past investments quite high, which means that then the net income is lower, and therefore the price to earnings is higher. Yeah, but it also means that the free cash flow is higher because it's not investing so much at that time. For me, that could even be a red flag, because why would a company underinvest at the moment here? What's changed? Is the company or the management just trying to, on the short term, I said, boost everything up because their bonuses are tied to it? Is this there for short term thinking? So for me, if they are really for long term, let's say, out of sync, it's a red flag. Maybe let's say a warning sign that I really want to understand deeper, because over time, it should kind of, if you would sum up over the last 10 years, the free cash flow and the net income, it should be pretty similar.
Cool. Rane has asked us about Chevron. What do you think about their correction this month or last month?
So I think Chevron is probably one of the best, if not the best, managed oil and gas stock. And yeah, if you don't own Chevron at all yet, I mean, it could be interesting. I'm not going to advise it, because we don't do such things. I can just tell you my perspective that for me, I've got a lot of oil and gas in my portfolio, and for me, the time to buy oil and gas is when it's all the time on CNBC, because the oil price has been tanking. Now it's like calm waters, relatively. Yeah, it's a tough one. But if you're convinced about the company Renje, then just know it's a high quality managed business, in my opinion.
And then the last question of the day goes to Adrian, who's asked us about our opinion on Scorpio tankers, ticker symbol STNG. I think I've said this on this podcast before, but there's a guy on Twitter who knows this industry, I think, better than anyone. There's a lot of free webinars and a lot of information. I think it's Jay Mintzmeyer. His Twitter handle is @Mintzmeyer, and generally I would suggest following his account for these types of companies. He did put out a tweet yesterday or the day before specifically about tankers. He thinks it's time to get into these. I think there was some news about OPEC. I think that fear that was there for the last 2 or 3 months is gone, which has suppressed some of these guys' share price, and there's probably a time to get into them. But look, I'm not an expert in this field. Macroeconomics probably plays a lot more part in these type of companies than what we'd be used to. So check out Jay's page on Twitter. It's honestly, I follow it. I don't follow what he trades and what he does, but he's always very insightful. I actually watch his webinars, watch when he's giving things, and he's very transparent. He'll give you his top 3 picks every quarter, and then go back and reassess their performance, good and bad. So I think he's definitely worth a follow, particularly if you like these types of companies. In terms of dividend, I found with these companies it can be quite choppy and not predictable. So it's hard from a dividend growth perspective to, as you said, it's a young, small, growing dividend. It's too hard to really know how predictable and stable that is. So there we have it. That's the end of our show. Look, it's a show. Probably has a sad note. Normally we're a little bit more positive or upbeat. It was built off what happened this month, or this week, I should say. But yeah, lots to learn from Charlie. Lots to learn from him.
So. Definitely, and I think we owed him his tribute, but let's leave it here as well, because the guy will still be so often visible on YouTube. He's everywhere with his video clips, so his body may be gone, but his mind is still living on. And awesome guy, and happy that we dedicated this show to him.
Okay, to all our listeners, thanks for tuning in, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.